The German Chancellor Angela Merkel threw a spanner in the works when she came out opposed to the idea of common euro area bonds as a means to solve the debt crisis engulfing Europe, saying that she won't let financial markets dictate economic policy. She said a joint eurobond would lead the EU into a debt union and not a stability union. Each country has to take its own steps to reduce their debt, she says. We're now joined by Ian Cruickshanks, who's head of Treasury at Nedbank. We're also joined by Chris Hart, chief economist at Investment Solutions, to just unravel this particular issue for us. Chris, the whole idea of common eurobonds has raised the ire of Angela Merkel and it's become a very contentious issue. Why?
Well, I think it's effectively an attempt to transfer the responsibility of debt incurred effectively to the stronger countries, the countries that have managed their affairs in a better way than other countries, and it's in a sense it doesn't resolve the fundamental underlying issues, which is effectively governments have promised more to their electorates than what their tax bases can deliver. You've got exhausted tax bases, etc. And you can't transfer that responsibility onto the German taxpayer without resolving that fundamental issue first. So to have debt convergence, you can't really expect a country that's got a 60% debt to GDP ratio carry somebody who's got 110% debt to GDP ratio, etc., and different tax rates, etc. It's just not feasible. So all a eurobond now would do would be to kick the can down the road, but you wouldn't be resolving the problems.
In your views on this one, somebody like George Soros has been quoted as saying they have no choice. They have got to consider eurobonds. That's the only way to sort out the problems in Europe.
Well, I don't agree with George Soros in this case. Despite his phenomenal record, I think I'd go along with Chris and talk about convergence. When all these countries went into the euro, their interest rates had to converge. And they did. Why should those poor quality borrowers suddenly be able to borrow at the same rate as Germany? Because they were hanging on the ratings of Germany. And they have disproved their ability to justify that. And I think this is the difficulty. They have acted irresponsibly and now expect the responsible Germans to rescue them. It's understandable that the electorate are up in arms about it, and I think that quite rightly that they should be too. Also, Chancellor Merkel wants to stay Chancellor, and if she lets the electorate down, there's a danger there too.
Well, that explains the German view on this one, their resistance on this one. What about the behavior of the rest of Europe, this irresponsibility that Ian is talking about? Because some people are saying, you know what, hindsight, is the best sight. The Europeans shouldn't have gone for a common currency before they'd worked out a means for common economic policy.
Well, I think in a sense, hindsight is the best, because I think the establishment of the euro was actually quite smooth. It wasn't a problem. And it was only in the wake of the 2008 financial crisis that the markets woke up to the thing that the risk is not homogeneous. It's actually quite diverse. And the global financial crisis, in fact, exposed that particular weakness quite strongly. And so from the convergence trade at the start of the euro, we're now getting a divergence trade. Now, the question of what George Soros is saying, is he not just covering his own vested interests, etc.? Because that seems to be the way, is to consume and incur more debt kind of thing as a solution to a debt problem. It's not going to work. You actually have to pare back the size of government, you have to pare back the size of the debt, to actually free up the growth potential of Europe again.
I like the euphemism, vested interest. Ian, let's talk about this whole idea of common economic management. We've got countries that have not met the target for the deficit, which is somewhere in 3.5%. They've got debts ranging from 6% of GDP to 142% of GDP. And all of these people are supposed to be working in tandem. What's needed to get them working together and meeting the same objectives?
Some very tough such decisions have to be taken. Take Greece as an example. They fudged the numbers when they went into the union and then admitted it. And the other chap said, there, just try and get it right. That was a mistake. They have to have a set of rules. They should adhere to them strictly. Otherwise, they should say, I'm sorry, you no longer enjoy the benefits. Of course, that's difficult for Germany because as the world's second biggest exporter, their export markets are clustered around them. But nevertheless, I think it has to be taken that unless they can stick to the rules, they're going to not get the benefits that they did in the euro. The euro may have to end up being a much smaller currency. There's no short-term satisfactory alternative to that in my mind. It's drastic, but I think it has to be considered.
But even Merkel and Sarkozy came up with an idea last week, for instance, this Tobin tax, right, which still tells me that not even they are thinking of a solution. They're still trying to draw more revenues out of a weakened tax base. And the balance between consumption and production still has to be restored. And that's the problem when you've had, you could say, 40 years almost of a spend now, pay later kind of policy. And we're not, and that's where they need to resolve. The tax burden needs to be lowered and the expenditures reduced so that it's actually sustainable.
Instead, it's going in the opposite direction.
Going in the opposite direction.
Let's hypothetically indulge the idea of a eurobond. What would go into managing eurobonds? What would make them attractive, and how would that help us resolve the current global problems we have?
Well, the first thing is that it has to be this. All other debt needs to be subordinate to that. So, in other words, if Greece had a mixture of Greek bonds and the euro debt, its euro debt that it would have issued would have to take precedence. So in other words, if the others have to default, so be it, but they'd have to actually meet their obligations as a priority. And if they don't, it's almost as if you have to go and invade them and take the resources to actually do it. It can actually lead to a lot more. That's why I'm saying if it leads to just additional tensions down the road, but just papers over the cracks now, that's effectively what's going to happen. But it has to be a common pact. And if there's rules being broken, you've got to actually give up your sovereignty effectively to actually allow other European nations to come in and manage your affairs.
And Loretta, just think of the angst of those investors holding the existing bonds. They say, hey, our paper must be subordinated to this new paper that comes along, and say, no, why should we? It's going to be very difficult, not only getting the debtors themselves on the same side, getting existing investors to go along with that. That's going to be, I'm not sure that can be overcome.
Let's stick to the point you raised, Ian, about what we might need going forward is a smaller Eurozone and a smaller currency in circulation. What does that mean for African countries? Because so many of us have Europe as a trading partner.
Yes, and of course for South Africa it's very important. The European Union as a bloc of countries is our most important, our largest international trading partner. So we could see that if they fragmented and went their several ways, not supporting each other, there may be less accumulative demand for our exports. That could have an impact on our trade account, our current account, and on the rand exchange rate. So there are threats, and that would apply to all of the African countries.
Very briefly, our future?
Certainly, I agree with Ian, but a northern euro and southern euro actually makes sense.